Welcome to this brief introductory presentation regarding the design of an investment portfolio and the principles upon which this design is based. Let me begin by stating we do not believe in stock picking or market timing as active managers do. Rather than pursuing the expensive and elusive quest of trying to find ways in which the markets are mistaken, we take advantage of the efficiency of markets as a whole. We concentrate on designing client portfolios that tilt towards those systematic risk forms that have historically delivered higher expected returns. Our core investment principles are as follows. Markets work. Markets throughout the world have a history of rewarding investors for the capital they supply. Competition quickly drives prices to their fair value. Diversification is crucial. Traditional investment managers strive to beat the market by taking advantage of pricing mistakes and attempting to predict the future. Too often this proves costly and futile. Risk and return are related. The futility of speculation is good news for the investor. It is certainly possible to outperform the markets, but not without accepting increased risk. When costly speculation and guesswork is rejected, investing becomes a matter of deciding and setting an asset allocation with regard to equities as well as fixed asset classes. And finally, portfolio structure explains performance. It is asset allocation, not stock picking or market timing, that has historically accounted for over 90% of the performance in a diversified investment. Capital market research over the last 50 years has brought us to a powerful understanding of the risks that are worth taking versus the risks that are not. 3 systematic risk factors have been identified by world-renowned economists Eugene Fama and Kenneth French as the chief drivers of expected return in the equity markets. These risks are, number 1, market risk. This is the possibility that the value of investments could decline due to economic changes or other events that impact large portions of the market. It is because of this that stocks have a higher volatility as well as a higher expected return than that of T-bills. Secondly, size risk. Smaller companies are perceived to be riskier investments than larger ones due to higher operating and funding risk, and therefore the cost of capital and expected investor returns are higher. And third, price risk. Value stocks are companies with high book-to-market ratio. These companies that the market has given values close to or less than those of their accountants, the market views as having a less certain future profitability than other companies. Accordingly, risk is greater. Now we will see how utilizing these risk-return factors can improve overall portfolio performance. Please notice the return and risk amounts in the top left-hand corner of this slide. The time period used is the 39-year period from 1973 through 2011. It includes significant periods of economic growth as well as economic contraction. Here we have redesigned a standard 60-40 portfolio, which starts with 60% stocks and 40% bonds, with the stock investment in the S&P 500 index to a completely diversified global portfolio with exposure to asset classes with various risk-return dimensions. We did this step by step, gradually increasing exposure into those U.S. and foreign asset classes with higher expected returns. As demonstrated here, increased exposure to small and value asset classes, both in the United States and foreign markets, can increase your annualized compound return, while at the same time decreasing the standard deviation or risk of your overall portfolio. This diversification into certain asset classes is what we believe accounts for superior performance over time, not the likelihood you or your advisor can pick the next Apple. A globally diversified allocation harnesses the power of markets, manages the risk-return trade-off, provides broad diversification, and offers calculated exposure to compensating risk factors through structured investing.